Welcome to our Q&AMP video on diversifying investments. I'm Jess Arambulo, one of AMP's member education managers. Successful investing is about strategy, knowledge, goal setting, and steady progress. Over time, your investments can grow and create wealth, giving you access to new opportunities and the lifestyle you seek. Also, by creating a diversified investment portfolio, you can reduce your risk and take advantage of opportunities across different sectors. To give you more information on the value of diversifying investments and different ways to do so, I'm speaking with Shelley, AMP's Chief Investment Officer. Anna, can you give us a simple definition of diversification when it comes to investments?
Hi, Jess. Put simply, diversification is an investment strategy that lowers your portfolio's risk and it helps you get more stable returns. You can diversify by investing your money across different asset classes like shares, property, bonds and cash. And then you can also diversify across the different options or sectors within each asset class. So for example, if you buy shares, you might buy some bank stocks, some resource or mining company stocks, perhaps healthcare or energy stocks. You can further diversify by investing your money across different fund managers and different product issuers as well.
What's the value of it? Why do we do it?
So diversification lowers the overall portfolio's risk because different asset classes will perform differently at different times. So if one business or sector is performing badly, then there's less of an impact on your overall wealth. Having a variety of different investments with different risks will balance out the overall risk of a portfolio.
And what are some things to consider if we're thinking about diversifying?
There's a number of things that you want to consider. So, for example, while you're generally lowering the entire risk of your portfolio, over time, some of those investments will rise in value more than the others in the portfolio. And so that means that you might end up with more money in one asset class than when you first started investing, which means you're less diversified. So for example, if shares go up and bonds fall in price, then you're going to end up with a greater proportion of your money invested in shares if you don't rebalance back to the starting proportions that you originally had. So because shares are higher risk, then that will mean that your portfolio is also higher risk. You also want to consider if you just have a lower risk appetite or you can't afford to lose money, and then you'll want to adjust your portfolio to take that into account. It's more important too to be prepared for the possibility of lower returns if you do have a lower risk portfolio.
Let's talk about some different ways to diversify our portfolio.
A great first start is to have a good review of any investments that you've already got and see what they're worth. So that would include cash that you've got in your bank account, any shares, managed funds, even an investment property that you might have, the value of your own home, and particularly your super as well. That's going to show you how many different asset classes or different types of investments that you're investing in and where you might be able to diversify further. So, for example, if you own a house and an investment property, then you're really not very diversified in that sense. If property prices fall, you won't have any other investments to balance out that fall. So to diversify further, you could instead invest in different asset classes like shares or bonds. If you're not sure about the whole diversification thing, checking out your super fund is a pretty good way to get a good idea of an example of diversification. If you pop onto your fund's website or have a look at their annual report, you'll be able to see how they invest. So when you diversify, it's also not just about the different asset classes, because you can invest your money across different options inside the asset classes too. If you're mainly invested in one sector like healthcare, then you can research other sectors like mining and materials, or even commercial and professional services. So if you want to try diversifying, but you think you might need a bit of extra help, you can do it through a managed fund, a managed account, an exchange traded fund or ETF as we call them, a listed investment company, which is an LIC for short. ETFs and LICs can provide a low-cost way to invest in an asset class or to diversify away from other asset classes. Then managed funds and managed accounts can also help you invest across a really wide range of asset classes. Some managed funds and managed accounts offer pre-made or ready-made diversified portfolios, and those ones usually have labels which are similar to the labels on the options in your super fund, like conservative, growth, balanced, and the like, depending on their asset allocation.
Finally, Anna, with so much information available around investments, I'm guessing this area is sometimes quite hard for people to understand.
If you do need some help to build a diversified portfolio, you can talk to a financial advisor. And if you don't have an advisor, you can connect with one at AMP by going to amp.com.au/find an advisor.
Thanks, Anna. Some great information there. Here's a quick recap. A diversified investment portfolio can reduce your risk and enable you to take advantage of opportunities across different sectors. By spreading your investments across different sectors and businesses, and by using different investment vehicles to do so, if one business or sector fails or performs badly, it will have less of an effect on your overall wealth. This is because you're not keeping all your eggs in one basket. When planning how to diversify your portfolio, it's important to review the investments you already hold. This can include super, money in bank accounts, shares, property, or other assets. Establishing what you have now can enable you to work out how to better diversify and also identify the sectors or asset classes where you may be overweight and therefore more at risk of a loss. Once you've done this, a financial advisor can help you work out the next steps to build your wealth. Go to amp.com.au for further information. Please remember, this video hasn't taken your circumstances into account. It's important to consider your circumstances before deciding what's right for you.